Hi there. I gave a presentation a few days ago at McMaster University. There's this big event there called Shift 2020. Naomi Klein was a speaker there. And there was a session put on by a group called Mac Green Invest. And they've really been pushing the university's endowments towards divesting from fossil fuels and then reinvesting that money in the green economy. So they brought me along. I gave a little presentation. It was pretty cool. There were members of the investment committee who were either watching it live or I'm sure have seen it. Hopefully we rocked the boat a little bit, giving people just some facts and information about what divestment means and then how we can sort of practically reinvest that into green sectors. So I really hope you enjoyed the presentation. If you like it, give me a thumbs up, give me a like. You can ring the bell for the notifications for whenever I produce new content. But I've got some more presentations like this coming up, so hopefully I can keep recording them and sharing them with you on YouTube. Hope you enjoy it.
Thank you so much for having me. This is awesome. Thank you so much for participating, everybody who's come on, and certainly the organizers. And I really appreciate sort of giving me a bit of a platform here to be able to share the sort of thinking and the research that I'm doing around this topic of sustainable investing. So obviously the big question for today, should McMaster divest and reinvest in green energy? I think if you're on this call, you probably don't view this as a question. So, really I'm going to get more into the kind of how and what that really looks like. A little bit of background on me. I've been at this for quite a while. I did do my background is in economics and philosophy out at Dalhousie. I spent a year in Sweden doing my master's in sustainability. I graduated straight into the 2008 market crash and started my own business, and I've really been at it ever since. So you can see here, this is me taking on Kevin O'Leary on the old Lang and O'Leary exchange that was on CBC back in the day. And it really, I have been tracking this for a long period of time. My business model has been through a few different iterations. And where I'm at right now is basically I'm a financial planner. So day by day, I help people actually do this with their own money. So with this presentation, it is going to be more focused on sort of higher level, kind of institutional, because we are talking about the university's endowment here. That said, you'll notice a lot of my approaches, I do kind of use this language more geared towards retail investors. And that certainly is the focus of my day-to-day activities, is how regular people can invest according to their values. So really, when it comes to divestment, I think a really important distinction right off the bat has to be this difference between this acronym ESG, which I'll elaborate on in a moment, versus divestment. And I use the word versus there, although, to Jim's point, it's really not an either or. To me, these are very complementary strategies. But I do think it's important for me to kind of distinguish them a little bit so that we can have a really full conversation about this. So I'm going to start with the ESG, and the acronym ESG stands for Environmental, Social, and Governance. Okay, so it includes climate change. It does look at carbon footprint, but that would be a small part of this overall score. That would be one indicator out of probably like 300 different indicators. When we're evaluating, this is kind of what we talk about when we talk about how sustainable or how responsible a company is. Often what we're doing is in the industry, we talk about, well, what's their ESG score? There are a number of different companies that do this ESG data. I'm going to stick with one just for now called MSCI, Morgan Stanley Capital Indexes. This would be one of the largest, most well-known ESG data providers. They do have this really cool database. You can actually get these high-level scores for free. So I've got the link down here. If we wanted to, in the Q&A after, I can look at other companies. We can look them up. If you want to look at Tesla or something like that, happy to sort of go there. I chose Apple as the case study just because it is the biggest company. You can see that Apple has an ESG rating of single A. AAA would be sort of like the most sustainable, AA, single A, and then all the way down to triple C would be sort of the worst score there. That would be a massive red flag. From there, you can see that it does look at specific issues. These would be issues that are related to Apple's sector in terms of technology, hardware, storage, and peripherals. And that, just understanding where they are in the spectrum, Apple has kind of had to clean up their act, that fortunately they're not a laggard in any issues. However, They are average when it comes to corporate governance, human capital development, which is how well they treat their employees and the opportunities for employees to be able to learn and grow within the company, privacy and data security, obviously very important for technology companies. Supply chain labor standards. So this would have been a huge red flag. Apple really got dinged. It was many years ago where there was a factory in China administered by a third party called Foxconn. And this was basically an assembly plant. This is where employees would assemble people's iPhones. And the labor standards were just horrible, where such that employees were essentially committing suicide. And the factory, Foxconn, had to put up nets around the building to prevent employees from jumping out the window. Like, it was just so absolutely horrible to see those conditions. So obviously this was a huge issue. It really dinged Apple's reputation. So they have been forced to take action on that. They are no longer considered a laggard. They are simply considered average when it comes to these supply chain labor standards. On the environmental side, obviously e-waste, huge issues here. And then where they are a leader is opportunities in clean tech. So Apple has done like $1 billion green bond. They've actually built out a whole bunch of renewable energy projects such that their US operations are quote unquote, powered by renewable energy. There is as much renewable energy flowing into the grid as they're using. And that they are leaders when it comes to controversial sourcing, which is going to be around things like conflict minerals, which obviously there's a lot that goes into those phones. So you can see that this is like a much wider definition of quote unquote sustainability. When we look at these ESG data points, carbon footprint is certainly part of this. But, obviously with a company like Apple, it's not going to be the most dominant one. It's going to be one of many different issues. So, really what I'm here to tell you is that, when I started doing this, when I was talking to Kevin O'Leary in 2010, people thought I was nuts. Nobody was looking at ESG data. Nobody was considering this in investment decision making. And now investors are really starting to catch on. Back then I kind of got told I was called sort of like a tree hugger or a hippie, talking about some of these issues. So I figured I would present some quotes from some other hippies that are now on board. So here's the Harvard Business Review saying that mounting evidence shows that sustainable companies deliver significant positive financial performance and investors are beginning to value them more highly. Back then when I talked about ESG and sustainable investing, people assumed lower financial returns, right? That, you're throwing your money away. There's one line, it just drives me nuts that, people have thrown it in my face saying, what is it? Get woke, go broke. And, here's the Harvard Business Review saying, well, actually, that's not really the case. Here's another giant hippie tree hugger, RBC Global Asset Management. What they've said is that companies that score highly in terms of their approach to ESG factors tend to deliver higher cash returns on their investments than their sector peers. Oh my goodness, this is RBC saying this. Here's MSCI, that company I mentioned, Morgan Stanley Capital Indices. We found that over the last 5 years, companies with higher ESG ratings exhibited higher average return on invested capital compared to companies with lower ESG ratings. These are all quotes that really show that when we incorporate these environmental social governance factors into our decision making, we're actually finding higher quality companies that are more profitable. And there are a number of reasons why this is the case, but there's one thing I really want to highlight, which is this funny financial term called cost of capital. And this is the idea that when companies want to grow, they want to get bigger, that they need money. It costs money to make money, right? And that there is a cost for these companies to raise capital in order to invest in their growth. And what we're seeing is that across the board, companies that have a higher ESG score, they've broken it out by quartile here, have a lower cost of capital. And whether it's through equity, whether they're selling shares and issuing shares, or whether it's through debt, meaning that these companies are borrowing money to grow, any way you slice it, companies with higher ESG scores have a lower cost of capital, meaning that it's cheaper for them to raise money and grow. So this is, very, very clear evidence that investors have a preference towards investing in companies with these better ESG scores. and that's going to allow companies to be able to raise money and expand more quickly. When it comes to financial performance, this is the most recent data I've got. This is a group called the Responsible Investment Association, a great group here in Canada. They track responsible investments. You can see here that this is a fund performance over the last 5 years. The blue lines are sort of the average responsible investment global equity versus the yellow line is going to be just the average global equity. You can see that in the last year, responsible investments have like kicked the crap out of traditional investments. And when we look at it annualized over 3 years and 5 years, that the responsible investments have outperformed. Now, I don't have the crystal ball. I can't promise that this is always going to be the case, that necessarily responsible investments are always going to earn higher returns going forward. I'm not going to sit here and promise that. I would be foolish if I did. However, I can tell you that if you did this 5 years ago, you would be substantially ahead, that you would have earned higher financial returns. And I am picking up a little bit of background noise. Welcome to anyone who's joined. If you wouldn't mind just muting your microphone, I would appreciate it greatly. From there, really I do want to shift gears from ESG and now talk about fossil fuel divestment just for a little bit. And really this is a chart that to me really highlights how important this issue is. What this does is this does look at an individual's personal carbon footprint, right? And it looks at these different issues, these different things, ways that we can reduce our carbon footprint. Obviously, we should all be flying less, right? Certainly now during COVID, I don't see a big reason to hop on an airplane. We should be driving less, we should be walking or taking public transit or cycling or, electric cars are a thing. And certainly we all should be eating less meat. Those are all things that I absolutely think we should do. But if you're someone who's taking all of those actions, doing all of those wonderful things that, because we're worried about our carbon footprint, but if you have ignored this issue when it comes to your personal portfolio, that having just $100,000 invested in the stock market wipes out the gain, the sort of carbon gains, the carbon footprint of all these different actions. And that $100,000, if you're approaching retirement, that's actually not really a lot. That a lot of people who are approaching retirement should have, $500,000 or even $1 million. You can see that the carbon footprint of your investment portfolio is just absolutely massive compared to these other issues. So to me, this is kind of the sort of personal responsibility slide where, I think a lot of us in this space that we're really deliberate about taking these actions that are going to reduce our carbon footprint. But if our investments are not aligned with that value of a low carbon portfolio, then, really it's like, hey, what are you doing? That this really should be top of mind for people who do have investments, who are actively saving for retirement or who are in retirement living off of your investments. Really this is a major source of personal carbon emissions. I want to be clear with some of the assumptions here that they've got built into this study. So number one is that this is 100% equity portfolio, so all stocks, there's no bonds, right? So, you're probably going to have a mix of stocks and bonds. Would just be the stock portion. And the way they did it is they did it 50-50 between global equity, so global stocks, and Canadian equity, so Canadian stocks. And obviously, when we look at the Canadian stock market, there is a really high carbon footprint there. That the Toronto Stock Exchange is still very heavily weighted towards tar sands, pipelines, and banks. And, obviously the banks have pretty substantial investments in that energy sector. So, really a couple of assumptions here. Also, this was 2018. So, whatever those weightings were, they have come down. And I'll show you why in a few more minutes. But, really this is kind of like the one, I would say, like preachy slide I'm going to show you. Just saying that, like, if you're not looking at these issues, obviously that's a huge problem. And, I'm curious, I don't know off the top of my head what the size of the endowment is, but, we could measure this is the annual carbon footprint, and you can only imagine what that would be. So again, when it comes to the university, would applaud a lot of these measures to be able to, make the buildings more energy efficient and to reduce the operational carbon footprint. But if you're ignoring the investment portfolio, you're just ignoring a massive part of that footprint. From there, I just did want to end up with, of course, the biggest hippie of them all, which is the Bank of Canada, the biggest sort of tree hugger or eco-activist in Canada, obviously, and really highlighting that this is an ethical issue, but more and more people are really realizing that this is an economic issue. That according to the Bank of Canada, this is their financial system review. So they identified climate change as one of the main systemic risks here in Canada. They said that climate change continues to pose risks to both the economy and the financial system. These include physical risks from disruptive weather events and transition risks from adapting to a lower carbon global economy. If some fossil fuel reserves remain unexploited, assets in this sector may become stranded, losing much of their value. At the same time, other sectors such as green technology and alternative energy will likely benefit. So this speaks directly to this issue of divestment and reinvestment. And you can see that, how far we've come, certainly throughout my career, where, really people thought I was out to lunch talking about this a decade ago. And now here we have the Bank of Canada identifying this as a massive economic risk. So, really, when it comes to performance, I've got a little chart here. This is since 2008. So, I took a little screenshot of this morning. The way to read this is, if we look at it, this is from before the crash. The blue line, this blue line at the top, this is something called the All Country World Index. So this is the global stock market, has done pretty good since just before the crash. The black line, this is IXC. This is the global energy ETF. So this would be the traditional energy sector. You can see has just really not done very well. And then PBD, this is the global clean energy ETF. Now, what's really interesting, I want to show you that there is some risk in sort of how far we've come, since the last crisis. That in 2008, really green energy took a major tumble. And it actually took a really long time for it to recover, right? And I think this was because, if you remember back in 2008, 2009, when we were dealing with that great financial crisis, really sustainability got thrown on the back burner. The economy came first. And really, it was all hands on deck to, let's get the economy going again. And then we can worry about these luxuries like environmental issues. The difference is that in this crisis, when I go forward, this is since COVID-19 hit. So I'm now doing the date since February 10th, which is right when, just as things were starting to get a little hairy. You can see that actually green energy sector has rebounded considerably higher. Whereas the traditional energy sector, this black line, has really, continued to stagnate. So to me, there is a sea change of response here that, when I look at the government response from 2008, 2009, that it was just entirely economic focus, that now there's huge conversation about how do we make sure that this recovery is inclusive, and how do we make sure that this recovery is green. And I gotta tell you, I'm just so happy to see this response. I really do feel that there is a real sea change in perception from what's happened there. So in terms of the change theory, because everyone's like, well, the impact, how does it work? And I want to be clear that when we're buying and selling stocks, we're not giving money directly to that company. We are buying them on the secondary market. So we are buying and selling from other investors. That said, there is an absolutely massive change here. And you can see that when it comes to divestment, when people divest, that means that there will be lower demand for that company's securities. It's going to be harder for them to issue shares. It's going to be harder for them to issue bonds, that those things are going to be more expensive. This means they're going to have a higher cost of capital. It is going to be more expensive for them to raise money to be able to grow. And that ultimately this means that these companies are going to be less profitable, that, the break even shift. And now that, really it's going to be harder for them to break even, let alone to drive that really high sort of financial returns. And obviously, as these companies are less profitable over time, that's just going to mean that more people are going to divest. They're going to say, no, these things I got to get out. Whatever. It might not be a philosophic or an ethical issue. This could cause people to do it very much for financial reasons. And this is just a virtuous cycle. that we've really seen this take off over the last, I would say, 3 years, where we are now, this cycle is happening on a continuous basis. Obviously, the flip side is true with the investment, that when people invest in things like renewable energy or clean technologies, that's going to create a higher demand for those shares and for those bonds. That's going to be a lower cost of capital, meaning it's going to be cheaper for those companies to raise money, which means it's going to be easier for them to be more profitable. And as they're more profitable, I would like to think that people are rational and that more and more people are going to invest in those sectors. So this really is the change theory when it comes to a secondary market. Obviously with me, with my personal money, I'm not going to have a huge impact on a company's cost of capital. But that said, us acting collectively, we kind of, hit this tipping point where we use Adam Smith's sort of invisible hand of the market. And this is how systemic change happens in the market. I do hear a little bit of background noise again, so unless someone wants to interrupt me for a question, I would suggest just muting your microphone. If you're new, welcome so much. I'm so glad you're able to join us. So where I want to shift focus now is to look at the practical applications of this and start to understand, how does an investor actually do this? Like, okay, Tim, I get it. This makes sense. I want to do this. How the heck does that work? So I'm going to walk you through my framework now. The starting point for my framework is that, I like to use this as sort of the standard benchmark if we didn't care about sustainability at all. You might have heard of something called the Canadian couch potato portfolio. This is a very, very standard investment approach. This is a guy named Dan Bartolotti. Again, he's looking at it from an individual perspective, how individuals should be investing. But this absolutely applies to an institutional portfolio as well. You're always going to have a mix of both stocks and bonds. So in this case, it's about 40% bonds, 60% stocks. Everyone's going to have their own little mix there. And the way people traditionally divide them up is they do want to be diversified globally. So part of it will be Canadian stocks, part of it will be US stocks, part of it will be international stocks. Very, very simple approach. So what I've done is basically copied or stolen this standard approach. And when it comes to building a sustainable portfolio, it's going to look very, very similar, except I do it a little bit differently. So we are going to have a mix of both stocks and bonds, right? However, the way I split it up is between what I call doing less evil stocks, right? So you're going to invest in global multi-billion-dollar companies, but what we're going to do is get rid of the quote-unquote evil ones. Now, everyone has a different definition of what that means. For some people, it's defined by ESG, and so we just want to get rid of the worst of the worst across each sector. For some investors, they're going to get completely rid of certain sectors. So the traditional sort of sin sectors are things like tobacco and weapons and gambling and things like that. And that obviously we're here talking about getting rid of fossil fuel companies entirely. Knowing that that's not just energy, that's not just oil and gas and pipelines, but it can also be mining companies that mine coal. It can also be utilities that burn coal, which is why I think it can be really powerful looking at that Carbon Underground 200, that it's not just a specific sector. This can impact different sectors. As well, what we want to do is carve out part of our stocks for what I call green stocks. So this is for me like doing more good, where we want to carve out part of the portfolio for companies that are part of the solution. This could be renewable energy, clean technologies, water infrastructure. There are funds that are now linked to the UN Sustainable Development Goals. Now, these are going to be a little bit different. They do tend to be a little bit riskier. It depends how you do it, right? There are a bunch of different approaches here. But, these aren't going to get you sort of the market rates of return. That with this, we are putting a bet on some of these sectors or some of these themes, like renewable energy. And if those sectors outperform, hey, you're going to do better. But if those sectors underperform, hey, you are going to do worse. So when it comes to this doing less evil approach, we are trying to earn these market rates of return, right? Just whatever the stock market is giving us, minus the stuff we want to get rid of. And then we can carve out part of the portfolio for things that we really believe in, that A, we feel good about, that we want to support, and that B, we think are going to grow faster than the rest of the market. When it comes to the bonds, I use the same approach, that most of the portfolio should be sort of these doing less evil bonds where we get rid of whatever nasty stuff we want to get rid of. And then we can carve out part of our portfolio for impact bonds, which I'm going to speak to in a few minutes, because to me, this is the part that I get the most excited about, where we can actually have that direct positive impact in the world that we're looking for. So, back in the day, 10 years ago, this was such a pain in the butt to divest from fossil fuels. I had to do this super complex portfolio with 11 different slices of the pie. Oh, it was just an absolute mess. And now, fortunately, things have come so far such that, I can build, I've got on my blog, I built something called my Squeaky Clean Portfolio, where it really is just 4 things, where it can be much, much easier than it was 10 years ago. That back then I really did have to sort of jerry-rig, get really creative in terms of how to remove fossil fuels from a portfolio. Now it's gotten so much easier. And, if there is interest in the Q&A, I can get into some of these specific products. From there, I do want to focus on this topic of impact bonds, because again, to me, this is just one of the most exciting things happening in the world. So impact bonds, these are going to be things like green bonds or social impact bonds, sustainable bonds. And you can just see the growth that we've had over the last few years. So this is from an organization called climatebonds.net. You can see it was globally, it was less than $50 billion issued in 2015. And then it's just continued to grow. And it's $250 billion in 2019. And I think it's already looking, I want to double check, but I think we're already over 300 billion so far in 2020. This is just a huge growth area for these impact bonds. And this is where, obviously you wouldn't want to do it with all of your money, but I think this is really where we can carve out part of a portfolio for this sort of doing more good approach. And, really to make it a little bit more local, you can see that there are a lot of options available here in Canada. Again, it's these giant hippies and tree huggers that are doing these green bonds. CPPIB is the Canadian Pension Plan Investment Board. They've actually done 2 of them, one for 1.5 billion. And then because there's so much demand in Europe, they actually issued a €1 billion green bond. Province of Ontario, the city of Ottawa, Scotiabank, and TD have even gotten in on this, right? So you can just see how mainstream this is getting. And I do want to make it really nice and local for you that, I know that there's a huge debate going on right now in Hamilton over the LRT. And, fundamentally what it comes down to is well, how do we pay for it, right? Well, the solution couldn't be simpler. Really, it would be so easy to issue a green bond to be able to pay, maybe not for all of it, but certainly a huge part of it, where we can actually raise that money using the markets. And, the MAC endowment could actually be an investor in a green bond that would actually help to build the LRT in Hamilton. So there's a great article that Eugene Elman wrote. I think Eugene is actually on the call, so happy to give him a really big shout out as sort of a local hero that understands how all these different things are connected, that we have this giant global financial system, that the university has this massive endowment that does want to be globally diversified, but through these initiatives it would be pretty straightforward for them to be able to carve out part of their portfolio for these impact bonds. And this could have a direct positive impact by creating a funding mechanism for a local public transit project. So, hopefully I've been able to give you kind of the high level with what's going on, as well give you a couple sort of, practical examples of how we would actually do that. That's it for my presentation. If you want to get a hold of me, my website, goodinvesting.com. I do have my blog at sustainableeconomist.com, although I'm actually going to be moving all that content over to goodinvesting.com soon. You can hit me up on LinkedIn or on Twitter. I've got a YouTube channel if you're curious for videos and things like that.